Hello everyone and welcome back for another episode of Market Bites. Hope everyone is doing very well. It is the first one of the second half of the year. Mental. I'd actually saw a tweet today. It's literally halfway through the year, which obviously isn't too surprising considering we're in July, but literally to the date, we are 50% through 2026. What a year it has been. We'll discuss that a little bit later. We'll also do a preview to next year. We'll talk about non-farm payrolls as well very shortly. Just a quick shout out from me. The link in the bio for the podcast and YouTube. A couple of Trader Talk episodes. MicroStrategy, of course, now called Strategy, was one that was reviewed. And also Alibaba. And I probably at some point going to do one on SpaceX. So do keep an eye on that on YouTube to check it out. Of course, still very early days on SpaceX. But before we get into what we're going to discuss, Neja, first of all, how are you?
I'm doing well, thank you, Sam. I'm sorry I couldn't join you last week. It was my daughter's first birthday, so we had a big celebration, and I was not able to join. But I'm glad to be back. How are you guys?
Yeah, very well. Well, first of all, happy birthday to Neja's daughter. The first birthday. Hopefully her investments are doing all right. A year.
Yeah, they are actually.
Yeah, I
Yeah.
was going to say it's not been a bad 365 days, unless you're heavily invested.
Naja, why'd you seem so surprised?
Uh, yeah, like we opened an account for her when she was born, and
Yeah.
we decided to go pretty aggressively since she's pretty young and she can afford some risk in her portfolio. So, yeah, but it panned out pretty well. So for 1 year of investing, 1 year of experience for her, I think she did pretty well. I don't know the exact number at the moment, yeah, but I was surprised how went it well.
Well,
How
yeah,
well it
Yeah.
went, yeah.
it'd be interesting to see how that compounds over time. She's going to be the next Warren Buffett, I'm sure.
She started young.
Started young, which is what all great investors say they wish they had done, started earlier. Brett, how you doing, mate? Independence Day in 2 days' time, gearing up for that?
Yeah, knocking on the door. Markets obviously closed on Friday in the U.S., so we're looking down the long weekend here. So it's never a bad thing.
Yeah, absolutely. A couple of years ago, I was in Vegas for Independence Day, which was good fun. And I'm sure there'll be some people listening to this that offer some celebrations around the US. Of course, the World Cup is on at the moment. I was saying to Brett and Neja before that there's been a bit of a rally in England to try and get a bank holiday on Monday. Obviously, Brett, as he said, has got one tomorrow for Independence Day. But yeah, we're trying to get one on Monday. It's not going to happen. But of course, we play in Mexico at 1 a.m. So don't expect me to do too much work on Monday morning if I get any sleep at all. But speaking of Independence Day, that meant, as Brett said, there is a bank holiday tomorrow in the States. Market is closed and it's the first Friday of the month, which therefore meant that non-farm payrolls was pushed a day earlier and was today. And I'm listening, they're always quite interesting. When I first got into trading, a couple of mentors of mine were like, this is it. This is the big one every single month, the one that the market's always going to care about. Now, of course, over time, sometimes inflation is going to take the main billing or a Fed meeting, but non-farm payrolls is still obviously very key, especially when the Fed at the moment are deciding whether to be more hawkish, dovish, or neutral. So the jobs report is an important pillar of that decision-making process. Brett, initial thoughts on it? It was a miss. Came in at 57,000. Is that right?
Yeah, 57,000. Bloomberg survey was 113. The prior month, big revision lower. I think it took it down about 25% from last month's headline. Interestingly, unemployment rate dipped, went from 4.3 to 4.2. So certainly a mixed bag. I'd say it was a disappointing report on the surface. I wouldn't say it's a disaster by any means, but I think it's funny. It's just sort of like this latest curveball, I think. Just when it seemed like you had the jobs market sort of figured out, like saying like, okay, we're not booming here with jobs, but like we're on stable ground, adding a decent amount every month, unemployment rates staying tempered down. And then all of a sudden you just get this curveball thrown in where it's like, Again, not a disaster of a report, but certainly a disappointing number. And the revision lower from last month really didn't help that case. Didn't help soften the blow by any means. But I don't know. I mean, I guess if there was a silver lining to it, it's A, it wasn't a disastrous report, and B, if it did come in way ahead, so like the survey was 113 was the expectation. Say it came in at like 150, 160, 200, whatever, notably above. That would put a lot more pressure on the Fed, I think, to be more hawkish or more aggressively hawkish, particularly in this upcoming meeting in July, but probably through this summer. And that's not to say that, oh, now they saw this report and now they're going to be dovish. But like, it takes that pressure off for that immediateness to raise interest rates and saying, okay, the jobs market's obviously fine. We're going to only focus on inflation. They can kind of keep that now. They can kind of lean back a little bit and say, well, we have to pay attention to both sides of that dual mandate, jobs and inflation. So I don't know. I wouldn't say it certainly wasn't a great report, but not the end of the world.
Yeah, and I guess with these things, you never really just take one report on its own. You
No.
hear about these like 3-month rolling averages, and the previous 3 months after a negative month for the February reporting were all pretty positive. 2 of them pretty much above 150. Obviously the previous one came in at 129 now, and obviously we get this 57. So I almost think it was for the markets rather than people looking for work. It was actually a pretty decent report, and maybe we've seen the impact on that on the expectations of the Fed potentially hiking. That's come down lower a little bit. For retail investors, and this is more of a general question, Leisure, rather than just a reaction to this. When you're, looking to invest and you've obviously got a longer term horizon, how much attention do you pay to just singular one data piece, whether that be CPI, whether that be non-farm payrolls? Is it one part of a major decision, or could it be that if there is a data announcement and it's wildly out of line, that's enough for you to make a move?
At most decisions that I make, I try to focus on more, more numbers, not just one, because I think that one number doesn't give you the whole picture. You get more information about labor market, what is happening, the wages, the unemployment, everything, basically what is happening on the labor market, but it's still, you don't have the full picture. So I think that investors that have long-term focus, I think you should take a look at more also inflation and what's happening with the Federal Reserve, all of that, to really give a perspective what is happening on the market. And I think that with current report that we got, Federal Reserve has quite a difficult job to do, because job creation is slowing, but wage growth is still above the forecast. So it's quite a difficult combination for Federal Reserve. And and it's not a clear slowdown that they want, because the ideal report would show that hiring is slowing and softer wages, but this report is only giving them one of these.
Yeah, I'm just having a quick look at the probabilities for the next meeting, which is the 29th of July. So just, 29th. My maths is going to let me down here. Basically 3 weeks or so, maybe even 4. But anyway, 0% chance of ease, which isn't a surprise. This is as of right now, or 15 minutes ago. No change, 80%, and a hike. I can't actually believe it's this high. 19.8. Yesterday it was 28.9. It just feels like it would be the wrong decision in my opinion. And I do wonder whether we fast forward a couple of episodes of Market Bites and we look back and say, God, it's a bit surprising that at one point it was, a week ago, for example, from now, it was at 32% chance that they were going to, raise interest rates. The market, listen, Brett, obviously a lot can happen in 3 weeks, but the market would not like a hike, I don't think.
No, I don't think so. I mean, that's I guess an easy answer, but it'll be July 29th. That'll be an interesting time, because that's like the last week of July. We'll probably have half the Mag 7 reporting in the same day as the Fed announcement, so that's always convenient. But I think the big difference though is, and maybe I'm looking a little bit too much into small caps at this point, but that has been like the under the radar trade so far this year. They're up like the Russell's up more than 20% so far on the year. It's the best performing U.S. index year to date and in the past 12 months. But that index has not wavered on the idea that the Fed may have to raise interest rates. And they're usually, that and tech are usually the more sensitive areas to that. Now, we've seen tech be a little more volatile lately. I think that's just kind of the semiconductor trade wavering a bit after that run has been insane. But small caps have like taken this news in stride. So I think if we do have to go with a hike or two, it's not good news for risk on assets. But at the end of the day, I don't think anyone's looking at it as this, big turning point in the markets. Like not looking at it like a 2022 situation, which was an aggressive rate hiking, an aggressive rate hiking plan from the Fed. There was multiple months, multiple hikes.
Mm-hmm.
I don't think it's the same situation. If it's one or two to knock inflation back down and then we go back down to current levels, I think the market seems to be okay with that idea.
Yeah, I
The
mean,
market might be looking at the situation of like on the perspective of hiking more like a fine tuning, not like 2022 situation when we were really talking about is that inflation pressure only, how did they say, like not only there to be for a few months and not to stay with us, but that in the end it's like it was not as they planned, and yeah, they had to hike for longer, as Paolo said.
yeah. Hopefully we don't get another 2022 kind of year for a while. It wasn't the most enjoyable time for
No.
retail investors or investors in general, really. Right, let's talk about what happened so far this year. Obviously, we could do a whole episode going into loads of detail, so I'll just flesh it out with some key bits and pieces, and then I'll come to both of you for what maybe stood out for you. That could be an individual stock, individual story, whatever. Personal milestone if you want. Nezha, you could talk about your daughter beating the S&P 500 if she did. I don't know. I guess one of the main things, and certainly when I do the podcast every morning, one of the first things, actually the first thing I look at before I even do any research is the price of oil. And oil's been incredibly volatile this year. It's performed, very well at the beginning of the year. It's come off better levels now for a few weeks, and I'm pretty sure it's round tripped the move from the onset of the war. Gold and silver have obviously been volatile, incredible end to last year, beginning of this year, and now they've come under pressure as well, which I guess for some people has been confusing on that idea that they're just always going to be safe havens, and that hasn't been the case this year. So that's certainly been something to focus on. Obviously, AI, a very big main market story that we've seen, and actually another part of that is actually some of those Mag 7s just haven't performed that well at all. And you've seen certainly Sandisk as well just continue to push on. I mean, when I was thinking about what's my main thing to focus on, I was almost just going to say, well, the fact that Sandisk did hundreds of percent last year and started this year with hundreds of percent, I mean, that's incredible moves as well that we've seen. Earnings overall were good, maybe unexpectedly very good, actually, I would say. And as Brett says, fast forward to the end of the month and we get the next batch. That's going to be a very key thing to focus on as well. IPOs are going to be a focus of the next half of the year, but the big one this year was SpaceX, and just one that, all retail investors had their eyes on. I've never seen X and clips online and podcasts just all talk about it, or a headline like that, or an IPO like that, ever. It was fascinating to see, and obviously retail had a big participation in all of that as well, which was great. It's come with its volatility now, as expected. That's obviously going to be one to focus on as well there. Concentration risk did remain. That was a big theme as well. And yeah, there's a few other little bits and pieces, but just a quick overview of that. Brett, we'll come to you. Was there an individual story, headline, anything for you that sort of tops it?
Well, I think I already used up my surprise guest of small caps, so that was a nice winner to see. I think this group specifically, but like our analyst team in general, has been looking for small caps to show any meaningful sign of life for a long time now. So to see this group come alive has been, I think, I think it's sort of like an ode to the bull market. I mean, it's always good to see small caps doing well. It's investors embracing risk. They have a good fundamental backdrop despite this like elevated interest rate backdrop. Um, but I think if I looked outside of that, I'd almost be surprised maybe by the underperformance of Mag 7. This is a group that I think every component in it besides Apple's down at least 10% on the year. No, a number of these names are down 20. I think Meta and Microsoft are down 25 and 30% apiece. Some of the valuations in this space are getting very low, relatively speaking, to their historic trends. So I think just in that perspective, to see the NASDAQ up almost 20% on the year, to see markets in general doing really well, to see tech as the best performing sector, yet doing it without any help from the mega caps, is maybe the most surprising piece of this puzzle to me so far this year.
Yeah. Nesha, what about you? What's the number one?
Well, yes, as Brad said, it's very surprising that Magnificent Seven is not in the focus anymore. That the winners actually shifted to semiconductors, memory chips, storage, chip equipment, all of that. And one of the most surprising stories for me this year is Intel. Because I think that it was one of the biggest shocks in the first half of this year, because the shares surged how much, like 200% in the first half of the year. And I think that's like a very good turnaround story. We thought Intel is done. They couldn't complete. They couldn't compete with their rivals anymore, and they were like lagging behind for so long. And now with all this optimism around them and all AI ambitions, like it's a true turnaround story. And I'm just wondering how this will pan out in the second half of the year.
Yeah, it'd be very interesting to see that.
And for Intel, if we ever see the U.S. government and NVIDIA both take a stake in a firm within a month of each other, I think that's maybe the next clue.
Yeah.
And actually, my number one thing, it probably would have been SpaceX. So I think it's fascinating. But the thing that I don't know whether I find it funny. I don't know whether I find it depressing, but I certainly find it interesting. Is just the company's reaction to any time Trump mentions one that he somehow is also invested in. I think it's just remarkable. And I saw some stats, and I'll read them out because they're just mind blowing. Trump made 3,642 trades in quarter one, right? Not even the first half of the year, quarter one. This annualizes out to be 14,568 trades a year or 58 trades a day. And for comparison, Nancy Pelosi made roughly 12 trades last year. So he's clearly got a team, right, that are just trading on his behalf. They know what's happening. And I find that fascinating. I'm a little bit jealous I'm not in the room when they say, look, I'm about to do a press conference and I'm going to mention Dell. So invest in Dell because it's going to go up 50%. So yeah, that's probably is it a highlight? Yeah, I find it fascinating, interesting, because you just couldn't imagine Joe Biden doing that or Obama or anyone like that. And yeah, it's crazy. I suppose another thing to mention is Bitcoin. Obviously, really since sort of the latter part of last year has just been steadily declining. Every opportunity where it's gone higher has been sold into. I'm still below, I think, I checked this morning or yesterday, still below 60K. And, I suppose for the longer term investor out there, that it's maybe getting to the point where they think it could be a good opportunity. But for what we've seen over the last 18 months, you had all these crazy moves in gold and silver. And there's an argument that took the shine from crypto, people that wanted those fast, explosive moves to the upside. Okay, well, great. Let me go to those precious metals. And then after gold and silver, it's like these AI stocks, these chip stocks that have taken the attention. And obviously AI companies have done incredible. And as you mentioned, a couple there, and obviously on previous podcasts we have as well. So maybe at some point when we start to see profit really getting taken, that crypto can start to recover a little bit more. And that will be something, I guess, will be an argument for people. Right, let's talk, just wrap it up now with, I guess, things to keep an eye on for the second half of the year. Anything you would add to these ones? Obviously, the impact of what central banks are going to do with interest rates. ECB, of course, have raised rates. Australia, they have. I mean, we were 30%, a 1 in 3 chance that the Fed were going to do it in their next meeting. That's, of course, now lower. So the impact from oil and on inflation is obviously still going to be a big story. So that's one, I would say. Obviously, can AI keep carrying the market? We sort of still need to see, especially in that next earnings report, whether companies are going to actually produce results from this big spend that they have done. And then, of course, we go into the second half of the year, and we've had one massive IPO already, the biggest of all time. And, you've got other companies that are looking to go public soon as well, which are big companies in their own right. So for me, I would say those 3 things. Brett, would you agree? Anything else you'd chuck in, or that's your main focus?
Yeah, it's crazy seeing, like, maybe I'm getting older now, but it's so crazy to see a T thrown in behind these market caps, and now especially as they're coming public, to see multi-trillion-dollar names hitting the tape as a new publicly traded firm is absolutely insane. I think for me, the trading junkie that still exists in me somewhere, my interest is like going to see how the AI trade unfolds. Like, we've seen it like evolve over the years and the quarters. Like a year ago, mega cap tech was like the trade in this space. It was the Nvidias, the Microsofts. Now these guys, like, you almost can't give the stock away at anything close to a premium. So I want to see, like, is that stay in the semi-memory space, or does that evolve into, does that go further down the, like, trickle down AI trade? Is it too soon maybe to talk about that? Maybe that's like a 2027 situation, but I think maybe the more analyst side of me would be curious to see, like, do we get a little more sector rotation through the groups? Like we saw healthcare pick up late in second quarter, industrials push to highs. So do we kind of keep that theme alive, where we start to see maybe some discretionary names, communication stocks? So we see some of those groups start to kind of come back to life and get some second half rotation in play.
I would like to add to that AI point trade that you made. I think that's like we obviously are past this phase 1 of AI trade that was the obvious winners like Nvidia, Metas, Alphabets, and so on. And I think that now we are obviously in the second phase, which is about infrastructure that is behind AI. And that's why we have such a big surge in chips, memory, storage, networking, so on. But I think that sooner or later we will transfer to this third phase, like where we are still expecting that hyperscalers will spend hundreds of billions of dollars on AI infrastructure. But I think that investors will also start focusing on companies that are enabling this AI adoption. So I'm talking about cooling system, power generation, networking infrastructure, and data center construction. It's nothing fancy, no big names, but I think that if we like slowly transfer to this stage, second half of this year could be much different, because AI, yes, could potentially still drive the market, but I think that we could switch the names that are in the main focus of in the news.
Yeah, for sure. A lot of people now, saying physical AI is what to focus on at the moment. That's the theme, and will be for the short to medium to long term. So names within that area will be fascinating. Right, that is it. That's our lot. H1 complete. H2 is beginning. Nezha and Brett, it's going to be a fun ride for the next 6 months. Let's enjoy it. Thank you all for joining. Thank you, guys.
Thank you. Bye.
Yeah. Thanks, Sam.
Take care, guys.